Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this Blue Hour webinar number 12, this one titled Delta Decisions. It happens automatically. How Delta is incorporated into our option selling trades. Now, most of the material that I present on this BCI website is a result of feedback that I get from you, our members. And lately, a lot of folks have been sending me emails asking if they have to look up Delta statistics before engaging in an option selling trade. And as we all know, Delta is a very important component to our option selling decisions. But today's presentation is going to show why it is not necessary to look up Delta statistics that is actually inherent in the BCI methodology as we structure our option selling trades. So first, let's have a look at a general overview of today's presentation. We're going to define and explain Delta. And we're going to set up a framework for our option selection. And we're going to show how this strategy structuring is related to Delta and why we do not need to look up Delta statistics, that it will become automatic as we structure our strategy. And finally, we'll show a real-life example of how Delta impacts our option selling trades and how our option selection process is automated within the structure of our system. Okay, let's start off with the definitions, and that's plural, of Delta, because there are actually three definitions that we should be aware of as it relates to Delta. Probably the most common one is the fact that Delta will show the amount that an option premium will change for every $1 change in the underlying share price. So if an option has a delta of 0.5 and an option premium of 2, and the stock changes up by $1, we would expect that option to move from 2 to 250. We'll get into more details on that a little bit later on. But that's the first definition of Delta. The second definition of Delta is that it's the equivalent number of shares represented by that option's position. In other words, it's a hedge ratio. A lot of portfolio managers will strive for Delta neutral portfolios, meaning that if they're long a stock, that will create a certain number of deltas. Every share of stock has a delta of 1. So the more shares of stock that we own, the more susceptible we are to market risk. By then selling options, we are decreasing the number of portfolio deltas and therefore decreasing our portfolio risk. So delta will represent the number of shares represented by an option's position. So if a particular option has a delta of 0.6 or 60 per contract, that would be the equivalent of owning 60 shares of stock. And if we sell a contract, that would be the equivalent of selling 60 shares of stock. Once again, this is as it relates to a hedge ratio for decreasing our market risk by decreasing our total portfolio delta position. Okay, now the third definition of delta is the percentage likelihood that upon expiration, an option will expire in the money. So if a call option has a delta of, let's say, 0.9, it has a 90% chance of expiring in the money by expiration. If it has a delta of 0.1, it only has a 10% chance of expiring in the money. And this would be important to people that want to retain their underlying shares. So if, for example, we